We're live. Hi, everyone, and thanks for joining us. I'm just still going to give it 1 minute while people log on to join us before we officially start. Can I just ask Timo and Yama maybe if you can mute yourselves for now? Thank you. Perfect. I saw there's a really great registration list for this webinar today and very international. So just as a side note, I'm logging in today from London. It's a really nice sunny afternoon, actually. And yeah, thank you for making the time to join us. We can still see some people coming in, so we'll give it a couple of seconds before we kick off. Okay, so that was a fast minute. I think we can get started now. Perfect. So hi, everyone, and thank you for joining us today for our webinar, Real Estate Trends 2023. My name is Rosanna Woods. I'm Managing Director for the UK and Benelux here at Drooms, and I'm really excited to be joined by a panel of expert speakers that will help us put some light on what are the biggest trends shaping the industry this year. And I will kick off by asking Timo Tschammler, Executive Partner at Twain Towers, to introduce himself. Timo, over to you.
Hello, everybody. My name is Timo Tschammler, speaking to you from Berlin, Germany, in my role as founding partner of Twain Towers, a small consultant boutique. Maybe a couple of guests today know myself from my former role as CEO of Jones Lang LaSalle in Germany.
Thanks, Timo. And I'm also really honored to have Christiane Conrads, Global Real Estate ESG Lead at PwC, joining us today here.
Yeah, thank you, Rosanna, for inviting me. Hi, everyone. I'm also very excited on looking forward to the discussion. As you mentioned, Rosanna, at PwC, I lead the global real estate ESG practice, which is actually an interdisciplinary team consisting of consultants, lawyers, tax advisors, auditors, and many more. And our focus is helping our clients with the current ESG transformation, with ESG strategy development and implementation.
Thank you. And we also joined by Yama Mahasher, Managing Director at Westbridge. Hi, Yama.
Hey, Rosanna, thank you. I'm happy to be here today and to present one of Europe's leading ESG advisors, Westbridge Advisory. My name is Yama, and I'm a Managing Director at Westbridge. My responsibilities include corporate development, strategy, and business operations. And before taking on my role at Westbridge, I spent the last 11.5 years at JLL, most recently as COO and Head of Operations Central Europe. I live near Frankfurt, and I'm a passionate fan of Eintracht Frankfurt, and I went to the stadium yesterday, so sorry for being not that fit today.
Thanks, Yama. And last but certainly not least, Rebekah, Tobias, Managing Director at MARCOL. Great to have you here.
Thanks, Rosanna. Great to be here. Rebekah Tobias, Managing Director at MARCOL, which is a family-run investment firm focused on real estate and private equity. We're pan-European investors. I run a team of investment and development professionals, and our strategy is mainly operational real estate across Europe. So great to be here. Thanks again.
Thank you for all introducing yourself. I will just have a very quick guide through on Livestorm, the platform. So if we can just bring up the webinar guide, you'll see a couple of icons in the bottom because we'll be running 3 polls today. So let me actually, I think I can click it myself. Perfect. So the quick webinar guide, you will see some icons at the bottom, and the polls one is particularly interesting because we'll have 3 polls and then you will be able to participate in the audience. We will also have a live Q&A at the end of the session. So we'll be around 50 minutes discussing within the panel. And then we will basically go over and answer your questions. Last but not least, we have the chat functionality where you can interact with us or also with the audience. So feel free to post anything. And for the best question posted, we'll also send out a €25 Amazon voucher at the end. Fancy that. So to get started, we're going to I want to start off with our first poll. And I showed you right now the icon where you need to go, because we have a large audience and we'd really like to have a bit of an understanding who is watching us today and who's part of this. So can you just click on what your current job is? We have the option asset manager, investor, fund manager, broker, lawyer, just to give us an idea what's dominant in our audience. So I'm just gonna, wow. Okay, so everyone's still voting. Amazing. Thank you for participating. Okay, let's give it a couple of more seconds. Okay, so I would say there's quite a large mix here. Really strong in other investors, quite a few. Okay, perfect. So I think that gives the panel a good idea of who's here today. And let's start right off by getting into it and asking our panel, in your opinion, what will have the biggest impact on commercial real estate revenue in 2023 and why? Timo, do you want to lead the way?
Yeah, I can. I think the biggest impact on the transaction front is the question around the current mismatch of interest rates and yields in the market. I mean, we've seen this since easily second quarter of last year already, with investment volumes falling harshly in a lot of target markets, especially across Germany, but surely in other European markets as well. So that doesn't seem to bounce back for now in the year 23, from my point of view. It seems to be a little bit of a deadlock, which continues throughout the start of this year with, yeah, as I said, mismatching ideas around pricing and also price opportunities, looking at the interest rates raises over the last quarters between potential buyers and potential sellers. And as long as this stands still and deadlock continues, I think that will be one of the biggest impacts we continue to witness in 23.
Thanks, Timo. Who would like to continue? Maybe we continue with Rebekah?
Yes, I agree completely with Timo, but I would also say it's just the rising cost environment. You know, we have certainly in Europe in particular, a energy crisis in addition to inflationary pressures across the board. And so I think the most difficult thing is, one is where asset valuations today, because without transactional evidence, we don't, have hard evidence to put a value on our assets today. And secondly, it's really how do we price assets if we're looking at cash flows for the future? So the accuracy of our underwriting assumptions and our exit yields, I'm explaining to my team that, if you've only been in the profession for the last 10 years, you've been living in a relatively free money environment, and that at some point was going to come to an end. So all of our exit yields have to be pushed out. How far, given where interest rates will end up, which is a normalized environment, for those of us that have been around a bit longer through various different cycles now, negative interest rates were never going to be sustainable. So we need to get to a sort of normalized position on that. Plus, I do think inflation is starting to top out, as we will see going forward. And over 18 months, I think it's, it depends on who you speak to, and the certain research and economists are predicting, back to sort of low, 2-3% inflation ongoing. So I think that will help bring more confidence into the market in terms of trying to predict the future when we're underwriting assets.
Christiane, ladies first, I would say.
Thanks. Yeah, thanks. Yeah, actually, yeah, of course, I agree what Timo and Rebekah just said. And yeah, so we see a very high degree of uncertainty for all the stakeholders of the real estate industry right now in the market, and actually advising on ESG. So the ESG transformation is also kind of contributing to that uncertainty. So we see more and more regulation affecting all the various stakeholders. We see like a giant legislative project happening right now in Europe with the sustainable finance regulations being implemented step by step. We have many dynamic regulations which will be further developed. And then in parallel to that, we see all the various member states who kind of implement their own more like top-down regulation, impacting the real estate industry, for example, implementing more and more energy efficiency requirements. So that will also kind of have an impact also, of course, in this year. To my feeling, we are in this very complex dynamic development at the very beginning. So it's still a long journey to go. And last but not least, what we also see, it's very diverse picture when it comes to stakeholder demands. So also we see now more and more corporate occupiers and tenants also focusing on their ESG agenda. And this varies between industries, it varies between areas as well. And just a quick quote from one client who called me a couple of weeks ago, and he said, actually a prime office developer based in Germany, and he said, okay, my property's already old before they completed. And I say, why is that? Are you not sticking to the regulatory requirements? And what he said was, no, the tenants don't want it anymore. So they have come up with very different demands, for example, net zero in the construction process, or they even have demands on the other tenants in the buildings. So that's also going to be, I think, one of the biggest challenge from an ESG perspective in 2023.
And Yama, what do you see as one of the biggest impacts?
Yeah, not that much to add, but it's all about asset values and long-term stability. So what we are seeing is that the real estate industry relies on predictability, and it's difficult at that time. But there's one thing we can predict, and ESG is the way to go in the future, and it remains a top priority for investors. So, we are speaking to hundreds of clients, and we are conducting hundreds of ESG-DDs, and what we are seeing is that there's a shift towards new asset classes. So we need more investments into energy and infrastructure, life sciences, data center. It's about stability and finding alternatives.
Yeah. So we actually, I would also like to share some results from a recent survey that we conducted internally from Drooms. We surveyed 229 real estate experts in Europe on their predictions for 2023, and we saw a reflection of the points you mentioned right now. The first trend being rising inflation, ESG regulation, high interest rates, payment failures from tenants, and high building costs will all have an impact on revenues this year. Based on our research, we found that 42% of the real estate professionals surveyed think that interest rates will be the most significant factor. Of course, the ESG topics also very clearly here, but this is a trend we identified from that survey that we conducted. So based on what we just heard now, what are your business expectations based on the economic outlook for 2023? How will real estate transactions be impacted? Rebekah, let's start with you.
Getting straight to the punchline, a discussion I had internally the other day, which is we're still in a competitive environment with a lot of capital around. It is more expensive, obviously, but there is still a lot of liquidity in the market. I think in order to compete going forward, the realization is that we all have to be taking more risk in the market to achieve the same or potentially lower return environment going forward. And it's whether or not we can justify that as a firm, and whether our LPs or investors or co-investors also come to that realization, because that is the environment in which we are having to work and compete in. So I think it's that risk return spectrum and where we are, and going forward, it's not going to be as easy to drive value. We're value add opportunistic investors. So inherently, we're always taking more risk. It's why we're in alternatives. It's why we're in operational real estate. And all the different layers of risk, especially if you're value add and above, you're having to take more construction and development risk, and that all, is a lot of variables that you have to get right. And obviously you can build in a margin, but then if depending on what margin you're putting into your models is whether you can compete in the environment that we're in, where you have cheaper cost of capital competing for the same assets. So I think I've been having this, conversation for months internally as well. And it's, I imagine the same for all of us having to deal with investors, which is, are you still willing to compete in this environment? I was also just reading a really interesting report from PitchBook over the last year, and they sort of predict where value add opportunistic returns are going in the future, forecast for the next 10 years. And it was very interesting to see there's very little difference in the overall IRRs between value add and opportunistic real estate. So you have to think, am I willing to take more risk for, again, the same or lower return? So it's going to be quite an interesting environment. Of course, I think we will see distress as well, and pockets of distress coming through with refis coming up, and investors just willing to offload assets at a value which is ultimately probably going to be below their book value. So I think we will start seeing that, and there will be opportunistic investors picking up on those opportunities. But it's going to be a much tougher environment, to be able to hit those returns that we've sold, our investors at the end of the day.
Can I jump in here, Rosanna?
Absolutely.
Because I might disagree, let's say, to one of the earlier arguments
Yes.
Rebekah presented, which was that there's still a lot of pressure of capital and the wall of money hitting the real estate markets. I'm not sure that this traditional argument still holds. Why? The big institutional investors often have to reallocate their portfolios when one asset class falls compared to another one. So with equities being hit hard after Ukraine, after the energy price crisis, still partly after Corona, there's a forced reallocation within the portfolios, potentially pulling money out of real estate and real assets into equities. Secondly, within the reviewed, okay, one is gone. I hope everybody can still hear me. As soon as I hold against her argument, she disappears. That's not fair. So secondly, within the reviewed financing and interest rate environment, each investment pulls more and more equity contribution compared to last year, for example, or 12 months ago. So again, this eats up equity, eats up capital against the background of unchanged investment volumes. And last but not least, and that hasn't been true for many, many years, investors do have alternatives again, which look more sexy than they did years and a decade ago, maybe, which is government bonds. If you look around at German Pfandbrief interest rates, at government bonds of low-risk European countries, obviously their interest rate or yields level has increased dramatically, hence offering a real risk-adjusted, let's say, alternative to real estate investment yields, which traditionally should show a difference to non-risk government bonds. So just to present three quick examples why I think that the so-called wall of money might well be continue to be under pressure this year.
Thanks for hopping in, Timo. Yeah, I think it's always interesting when there's these also different views amongst the panel. Yama, would you also like to add your opinion on it? I saw you had some comments.
Yeah, sure. So we are seeing all these trends, and all the economic consequences are clear. So all discussions are around fear, inflation rates, interest rates increasing, rising energy costs, and a potential recession. So what we are seeing, so the impact for the real estate transactions is that there is a focus on existing buildings, so that we won't see that much new buildings. As, for example, Vonovia just mentioned that they are not building anymore because it's too expensive. On the other hand, what we are also seeing is that all these investors and landlords are now looking at operating costs to ensure higher revenue and to see how they can just remove the gap of NOI leakage. So it comes back to value stability and to improve the asset's overall market position. And what we also see is that there's everyone waiting for the first seller to make massive value corrections. And the first half year will be quite quiet, and we're expecting a higher number of transactions in the second half of the year. But the big question is at which prices and multiples. And also, Timo, I agree. So there's a reallocation of institutional investors, the reallocation of the capital. Yeah, agree.
I think you made a great point around that discussions are revolving around fear at the moment. And I think it's clear to the industry that a storm is gathering or has gathered, and that there's going to be some challenges this year coming our way. But with all the challenges, you also actually always have the other side of it and some opportunities. So where does the panel see growth opportunities for 2023? Christiane, would you like to give your thoughts on that?
Okay, maybe also picking up on what Yama just said. So what we also see right now is due to the uncertainty in the transaction market right now, more and more clients try to make the most use of the time and look what they can do with the existing building stock and focusing on kind of building their ESG strategy or kind of further developing it. Because so what we see right now, there's increasing awareness that what's taking place right now is gonna have an impact on all the areas of the various businesses. It's affecting the transactional teams. It's also, of course, having a huge impact on the asset management, on the risk management. So this is kind of with the ESG transformation, hand in hand with that goes a kind of transformation within each and everybody in the real estate industry, and that requires kind of more efforts and people and know-how and money, and so that's actually something where people are kind of refocusing now. And speaking about growth opportunities, I think it's also, so of course it's taxonomy compliant new buildings, which is kind of the premium part, but also looking at all the various cases in litigation, climate change litigation, regulatory requirements, or also the refusal, for example, by the London building authorities to grant a building permit due to embodied carbon. So there's kind of a refocus on the existing building stock and kind of applying a more holistic approach to environmental and also social criteria.
Thanks. And within, Rebekah, within the strategy that you're pursuing at MARCOL, where do you see the growth opportunities in 2023?
Yeah, we have really moved completely away almost from traditional commercial office and retail, as many people have, into the alternatives, as I call it, but I don't know what really falls under that anymore. Self-storage is a sector we've been investing in for the last few years, which of course was, I guess, considered alternatives previously, and it's a main asset class, and it's performed really well through downturns. If you track the listed companies, you can see the performance. We've decided to take an approach where we're converting older stock, so there is a sort of repurposing element to that, which we are seeing across the board with the existing stock, and the carbon situation with new builds. We definitely prefer to be repositioning and refurbishing existing stock. So that's always been part of the strategy in any sector that we've been investing in, and self-storage has certainly been a main focus of mine over the past few years, and we're expanding that across Europe because it's very undersupplied. We also like, we have a petrol station portfolio, which you could say is not ESG compliant, but really when you look at EV stations, charging stations, what you can actually do with the site as well in terms of other providing, battery charging stations, the energy component, it is all adding to this sort of infrastructure energy focus, which definitely will be a core theme going forward. And for us, we like to own and operate our own real estate. So it's having the OpCo exposure and the operational risk, I suppose, which is the other layer of risk that some investors aren't willing to take yet. I think there will be a shift towards taking more of that operational risk and owning the OpCos. going forward. So we're seeing platforms being a major theme. And I do think, there's an obvious play there in terms of the arbitrage between the two, selling the business as a whole on a multiple of EBITDA rather than just asset value. So these are some of our trends.
Thank you. And Timo, would you like to add something to the opportunities that you're seeing on your end?
Sure. I think if we go through the asset classes, for now, there are no winners, right? Because at least as far as I think or believe to know, every single asset class, also the newer ones, such as infrastructure and others, do currently go through a repricing phase. And we don't know yet when it's going to end. And we don't know yet on which repricing level it's going to end. So I think as long as this risk is in the system, it's hard to point at a specific asset class and have a sure forecast and a solid knowledge that this or that class will recover quicker or come to a stop of correction earlier. So I think that's a difficult one to put money on and to put a bet on. I think there are sectors or services which are more easy to read, okay? So, for example, we heard that in different contexts today already. If there's a growing risk of assets to strand in the existing portfolios of investors due to increased legal and ESG pressure, then there will be a natural reflex to either look after those stock elements and do something while I hold them in my portfolio, or to give them to the market. But there again, it's a big question of repricing. So I think that's surely a trend which will continue also in a difficult year, 2023. Maybe if we look at finance, so interest rates are up. The capital markets are as well difficult to read for capital market maneuvers if you need fresh money or if you want to increase your capital base. So that suggests, from my point of view, that there's a growing and continuous need for alternative financing vehicles, despite obviously the classical bank finance. So I think this is a trend which we've seen easily starting in 2022 already, but that continues. And so I think if you go through not only the asset classes, but to the approaches to business and to the services which enter the market, I think there is room for growth, not so much on the asset classes for now.
And Yama, what are your thoughts on it? Do you see a wave of distressed assets coming maybe in the next few months?
Especially for private households, yes, which have concluded 5 to 10 year financings in 2013 to 2018. So it will come. On the commercial side, there will certainly be a tipping point at one point or another, as highly leveraged products are now have to be corrected in value, or the financing costs cannot be borne for long. So I would say yes, it depends on when, and what we can see is that PEs are gearing up to tackle the NPL market again. So there are signs, and it's depending on the timing now.
Okay, perfect. Is there anything else you'd like to add to that, Rebekah, about the distressed assets? Otherwise, I think I would jump over and look at it from a bit more of a cross-border investment focus, the discussion. Any comments to add? No? Okay, perfect.
Just really quick, sorry, Rosanna, just really quick on the healthcare side, I do see a big shift in investors focused in healthcare and needs-based demand, senior living. I think there's a lot happening still on the resi side across different profiles of tenants that will, we're still in a housing crisis at the end of the day. I do agree with the private housing side, that's with where mortgages are at the moment, but I do think from a commercial sort of wider real estate perspective, healthcare is a big area still to come in terms of growth. Yeah.
So if we shift now to the focus on the cross-border investments, so are you seeing an increase in international investments in the European market? And what do you think is causing this trend? How do you think this could change in 2023? Timo, can we start with you?
Sure. good question. I think there was a lot of hope in two directions. One, nationalities, and secondly, equity base. Yeah, and I would say again, I'm sorry to say it again, but it started last year and it continues this year. What do I mean by that? There was a point last summer when we had euro to US dollar parity. So $1 equaled €1. And obviously you could think at this moment that US dollar based investors take that opportunity to enter the euro-based markets relatively cheaply. Yes, there's still hedging issues to be covered, but still, I mean, parity doesn't happen too often, so it might look cheap from some perspective. Did we, as an aftermath, witness a strong increase in US dollar-based investors freshly entering our markets? Not to my knowledge, maybe marginal, but not the wave people were hoping for. Secondly, equity. Interest rates go up, okay, so finance becomes more expensive. Hence, for some people, first time in their real estate careers, they hear of a negative leverage effect. That's news in some of the ears of our colleagues, because since they entered the industry, there's only been a positive leverage effect. Now it can be negative as well. So hence, a lot of big shares of the markets were hoping for equity buyers to save us. But again, there are not that many. Yeah, you do have them. You do have not pure equity buyers, but entities and players who leverage by nature on lower and more healthy levels. But still, if you add them all together, they are not aggressive and active enough to save our markets. There might be some exceptions. Today, I'm not as internationally active as I was in my operational and professional past. But I just learned that, for example, in France, a lot of French entities took the momentum and the advantage to reinvest in their own home market more than they did years before. So they can benefit from the absence of international competition to refill their portfolios on their home turf. And I'm sure if you would go through different markets, countries, and borders, you would find more examples of that.
Yeah. Rebekah, I know that you're internationally quite active. Do you want to pick up on that and add a bit to what Timo said?
Yeah, it's a really good point, Timo. I do think there's a lot of private capital because we do co-invest with a number of global family offices, and that type of capital is not necessarily tracked, in the same way institutional capital is, and they all are equity-rich cash buyers that don't require leverage. And so I do think we will see a lot more of that, taking advantage of the current market and where debt pricing is. And that there is a wall of capital there, certainly globally, that want to be in core markets like London and the UK. New York has been absolutely decimated recently, along with San Francisco, but I do think those markets will start to look, certainly more attractive and more appealing. Europe, from a global context, will certainly attract more US capital, especially the UK, given the currency. So I do think we are going to start seeing certainly more private capital, all equity that will be coming into these markets. And that again is adding to the competition. If you are a leveraged buyer, how are you going to be able to compete given where you need to underwrite versus the private capital? So we are seeing that. We have a number of co-investors as well in the Middle East and Asia. It's the same situation with them. Middle East is certainly pegged to the US dollar when they invest. So again, that's very attractive if you're investing in a market like the UK. So I see a bit more action from that type of capital internationally. London's always been probably one of the most liquid. I think London offices will, whilst it's again very difficult to value at the moment, but I think they certainly, for grade A prime office from private capital internationally, it's always going to be the safest investment for them. So I do see signs of that, and certainly this is more, the prime markets versus secondary, and on a global scale.
I think we lost Timo. I think we lost Timo, but luckily we did hear his thoughts on this. Thanks, Rebekah. And Yama at Westbridge, what are you seeing there?
Yeah, definitely. You know, I think at the end of the day, it's up to investment volumes, and they might be lower than the years before, but Europe and especially UK, France, and Germany are safe havens and favorable investment markets. So let's see what will happen there. But what we are seeing and what will change definitely is the behavior. So it's not about just buying, holding, and achieving higher sales values without any investments. So I think the behavior of these investors will change, and they need to invest to gain profit. So this might be something which will change in 2023.
And if we'd have to pinpoint what the biggest barriers to international real estate investments are, what would you summarize that as?
So you're asking me.
Sure.
So I think Timo and Rebekah, they just mentioned a couple of fair points. But what comes in addition is, in my view, is transparency. So you know, we have a couple of risks coming up, political risks. You know, when you're just investing in Poland, which is into properties which are close to the Ukraine border, it would have been a good investment a couple of months ago, but not now. You know, you need to take into account a more broader view on risks, on political risk, and in addition to the financing piece and availability of products with a good return.
Christiane, I saw you unmute yourself.
Yeah, thanks. Yeah, maybe just adding from an ESG perspective. So I think what it's really challenging there, international capital flows, is a lack of harmonization. So we are currently conducting ESG regulatory mapping exercise for the Urban Land Institute, INREF, and UNPRI, where we look at the different regions, at Americas, Europe, and also parts of the Asia Pacific regions. And what we found there is, so there's a lack of harmonization taking place. So, and harmonization is also going to take a while. And why we have internationally accepted green building standards, that's only one part of the story. The story is much bigger in total. And in addition to kind of a race for regulatory standards and leadership. So right now, we see actually Europe is really advanced when it comes to governance and with the sustainable finance regulation, which I mentioned before. And also in other areas, for example, when you look at Singapore, so we see a strong focus on biodiversity. Singapore is also currently in the process of developing its own sustainable finance regulation. It wants to become leading here. It's drafting its own taxonomy, and 1/3 of the regulation will impact the real estate industry. And so looking at Japan right now, for example, there is a strong focus on circularity, but even within the markets, looking at the European market, there's also lack of harmonized standards, and only speaking about EPC standards. So one of my team members spent, I think, a couple of weeks this summer comparing the different EPC standards in Europe with each other. So that's something, but as Yama said, so there's a strong need for harmonization, also to enable benchmarking and transparency in this area.
Timo, would you like to add? You unmuted yourself.
You asking me?
Yes, I saw you unmuted yourself.
I have. I think there are some more maybe individual findings to add. What do I mean? I think some of the international investors who traditionally saw Germany as a safe haven do now feel disturbances. They feel disturbances from a macroeconomic level. So who thought maybe being a foreign investor into Germany, how dependent our economy is on Russian energy, for example? I think that was a steam learning when military conflicts arise on our borders. so I think this was a little bit of a shock, and that's not over yet. Yeah. So let's see. You do have, by the way, Rosanna, I just noted we do have questions and remarks in the question and chat list.
I saw that, and that's why I'm cautious that we will have 10 minutes at the end to pick up some of them.
Perfect.
So just sharing also from our side, we also asked this question in our survey, and interestingly, our survey found that 36% of the real estate professionals plan to increase international investments in 2023, while only 17% plan a reduction. There we go, the slide is following me, see? Perfect. And this also, we've touched now a couple of times on ESG already, and I'm very conscious that we have two specialists on the panel. So I would like to actually open up to our second poll and ask the audience, how prepared for ESG regulation is your business? We'll dive into a little bit more detail, and the poll is completely anonymous, so feel free to be brutally honest. You have the option between we haven't started, we're in the early stages, or we're fully prepared. So good, I can see the poll going right now. I think it's pretty clear that the majority is already heading in the direction of we're in the early stages. Thank you for sharing that, and I think that's also a really great indication to Christiane and Yama, who was on the panel. From your experience, how prepared are real estate investors for ESG regulation? Does it differ across asset classes or markets? Yama, would you like to kick off?
Yeah, sure. Really, I don't know if they are prepared. So just hiring an head of ESG or sustainability team doesn't mean that they are prepared, but it means that they are confronted. So they need to take action. You know, it's clearly coming that they're seeing the reality of upcoming GHG targets, whether they're self-imposed or externally mandated. And so there's pressure. And, we are seeing that investors are applying additional assessments on carbon performance of their portfolio and portfolio companies. We see pressure from shareholders, employees, the society. So they need to be prepared, and they need to start somewhere, and they're confronted now. Yeah. On asset classes, at some point, when it comes to data and data collection, it's easier for logistics than offices. When it comes to markets, it's easier to get the data in Eastern Europe countries than in Germany. It depends where you are, but at least they're confronted. Not that well prepared, but confronted.
Christiane, can you
pick up?
I
agree. Yeah, I totally agree. So it's just a very diverse picture which we see right now, and also what Yama said. So anybody needs to be prepared, and it's also we, of course, being based in Germany, we see the big institutional investors who kind of lead the game. So they've been really big ESG teams looking at the topic for like 15 years now, and then we also see kind of a more different approach. Many clients ask, like, okay, can you provide us with a checklist, so that we can work it along it and be prepared. So, and there's no, we cannot give you that. That's something. You need an individual solutions. You need to do your own stakeholder analysis. You need to know what kind of regulation is going to impact you or your stakeholders, and then you need to define your ambition level, how high you want to jump, that's also something which, an exercise anybody has to do right now. And are people prepared? I think many do something. Also, so starting with kind of photovoltaic projects, for example, e-mobility, energy concepts. Some others started to implement green leases, example. So that's also a very diverse picture. But like really real estate stakeholders who apply the ESG methodology, like in a holistic approach, life cycle analysis, that's only a few so far, I would say.
And if I might add, so Christiane, totally agree. And sustainability efforts are not siloed, so they go hand in hand with technology and innovation. and that means investments. And we are in early stages there, when it comes to data accuracy, data completeness. This is for me one of the biggest hurdles, because what we are seeing, if clients are looking for ESG data management tools, it takes them 18 to 24 months to decide whether it's A, B, or C. And, we don't have this trial and error mentality. And we need to start, we need to invest. It's trial and error. And yeah.
That's so true. Also, we see many projects and where clients start with a very high ambition level and they need to be paused because now we just need to collect data. We need to start with that, and it takes a very long time. Yeah.
Can I be, Rosanna, the party pooper for a minute?
Absolutely, absolutely.
I'm with Yama, who said maybe they are not fully on track, but they are confronted. Yeah, I agree. But I also would like to raise the opinion, let's say, that there are overlapping or potentially overlapping pain points. So in a market environment which has just witnessed the quickest interest rate increase since modern history, in a market where inflation goes through the roof and will increase potentially rental burdens so heavily, not only in the commercial but also in the residential sector, these are pain points where when people have to decide which fire do I fight first, where do I put my limited resources, where do I put my money to survive, will play a weighted role as well, I think. Or you wait and see.
Timo, I think we just lost you.
So we lost Timo. But Rosanna, on this point, so on some part of his comments, I disagree, because there are a couple of aspects of ESG, of emission reduction, decarbonization, which are not that cost intensive. So it's not about refurbishment, it's about energy costs, it's about energy procurement, it's about data collection, costs that can be passed on to the tenants. We need to start somewhere, and it's not just you need to invest hundreds of capex, euros, dollars into your roof and facade. So yeah.
We actually also included this in our research because this is a really important question to us. And there we also in our survey they answered to how prepared are they for ESG regulation. 33% said they are fully prepared to make the changes to meet the requirements, while 38% still see themselves in the early stages of preparation. So I think that really shows it's understood the message. Everyone knows this is coming. There's good intentions, but there's a lot of work to be done still. So I think, to make it a little bit more concrete here for the audience, for those that haven't started preparing for ESG regulation, and also keeping in mind the concerns that Timo raised, I think that are very valid, what would be your advice? And I guess we have also here the perfect advisors on the panel. So what would be your concrete advice then in a nutshell?
If I may pick this up, yes. Rosanna, I would say just Timo was right. There's so many challenges, but I think you still need to focus on the ESG topic because it's going to pick up, and it's we see stranded assets regulation coming up in all the various European countries. And the recommendation in a nutshell, get started, get your head around what is happening, what kind of regulation is affecting you today, which is going to impact you soon, and then get started and not just implement everything at the same time. It's about trial and error, and just make decisions on an informed basis and start to go with the quick wins, because there are some which are not that cost efficient, costly, and actually are very cheap and help you save money. And then start working on it with your entire teams internally and do it step by step.
And if I may add, Christiane, so you said it before, so ESG contains a wide range of disciplines. So there's not just one expert and just one skilled ESG professional that will solve all the problem. It's finance, it's legal compliance, marketing, communications, HR stuff. So my advice would be to partner up and this is what it's not. Of course, you can contact us at Westbridge, but it's what we are not doing that well, and what we haven't done that good in the past is to partner up to achieve our ambition. So this would be one advice. Yeah.
Thanks, Yama. I guess in this whole discussion, it's also we always hear like the innovation piece and also how important technology will be playing in this role. And there, I'm going to just launch our very last poll to have an understanding from the audience. Is your company increasing or decreasing innovation budgets this year? Because it will be a good reflective of everything we've heard, right? So let me just see, the poll is coming in right now. Oh, so far increasing, interesting. I think, so we can see clearly, although there's still response coming in, that innovation budgets are increasing in the companies. That's great news because it actually shows that importance has been recognized. Of course, there's going to be these concerns and pain points that were mentioned by the panel, but it looks like the message is well understood. And a last question would be on this: what technologies will the real estate sector be investing in throughout this year? What do you think? Maybe we start off with Rebekah. Like, what are you investing in technologies to assist this whole process?
Yeah, I would say something sort of, it's not very unique to us, but I think one of the things, because we invest in private equity and a bit of venture, that we've had a technology team for quite some time. One of the key areas of that is actually a product tech person to be able to look at the technologies in the market and decide what is best. And again, going back to one of Christiane's points, which was, I think, very valid, is it's an asset by asset basis. It's not a one size fits all. I think your asset business plan needs to include what technologies can help make this asset more efficient. And that's from the day-to-day running to the decarbonization pathway to the tenant engagement app. I mean, it's a range of technologies that are available today. You know, you have to have someone, though, really understanding, I think, the tech behind it, which is a different skill set, obviously. And I think that's really important to have in-house, in addition to a head of ESG and some of the other key areas of focus that you just can't brush over. I think you need this skill set in-house, which is critical. We look at technologies, you know, across the board, and especially in real estate, then we kind of look at the bespoke solutions that we can pull together. So it is a minefield. I would say it can be very overwhelming to someone who hasn't been involved in, you know, the prop tech space at all and doesn't understand the different products available in the market, because there's a lot of them, especially in the decarbonization space. That's becoming very crowded. So you do need to understand what is available, how is it applicable, and is it the right product for your asset? And again, it's not that costly. Actually, some of them are relatively cheap to implement. I'm really surprised, and this goes back to, I think, just the lack of understanding and awareness of the tech available in real estate, that there's the slow adoption rate and particularly slow implementation rate across the industry. We are one of the largest industries in the world, but the slowest to adopt technology. And this really has to change, because it doesn't make any sense. So we have to get smarter about this.
Absolutely. Would anyone like to chip in with a technology that they're seeing being implemented right now?
Definitely something around data acquisition and data management systems. I think this is one of the top priorities, especially in terms of ESG. And it is quite important to track the right KPIs and to measure them, and then having them ready to hand when it comes to reporting.
Thanks, Yama. So I'm just conscious of time, because we've had such a lively discussion here, that I did see that questions are coming in, and I do want to give the audience a chance to get something answered while we're still here live on the panel. Can the panelists also, you can see the questions, right? So one that I'm seeing right now is alternative sector has seen very positive rental growth, and yield impact has not been as severe as established asset classes. What is Rebekah's opinion on student accommodation? Okay, this one's directly at you.
Me. I think the student market is growing rapidly, and I think it provides a lot of very good opportunities to create some extremely stable and secure cash flows, which at the end of the day is the ultimate goal to achieve. So I do see a lot of appetite and a lot of interest in student housing. We haven't invested in it as a firm, but I think there's a lot of growth again in that area, and across actually all the living sectors. I see a huge amount of growth going forward.
Timo, do you want to chip in?
No, I was just scrolling through the questions, sorry.
Okay. So is there a particular one that you would want to pick up? I can see quite a few on ESG right now coming in.
I saw one where, sorry, I've forgotten the name now. Someone asked that mostly ESG is E, what about S and G? And I think that's a fair point, especially when it comes to data gathering and transparency. The S is probably the newest to be quantified. And for those of our guests today who speak German, they can have a look at some of the guidelines which have been published lately in Germany by the so-called Institute Corporate Governance, ICG, who published the Leitfaden for the S in ESG and social impact investment. So I think, at least to my knowledge, within the German-speaking region, that was one of the major releases, let's say, of a piece which helps with orientation in the S of ESG. Yeah.
If I may add to that one, that's also the approach of the European Union and also the various member states. So there's increasing pressure coming from legislation, for example, duty of care, supply chain requirements, the latest report of the Platform for Sustainable Finance with kind of really far-reaching requirements on that you need to make sure that there are no infringements of human rights or employer rights within entire supply chains. And that's something you need to review and adopt your due diligence process accordingly, and you need to disclose. So from my or our perspective, it kind of the EU and also the member states, they do not differentiate between E and the S. It's just more tricky to kind of find an agreement on the KPIs regarding the S.
Thanks. I think I'm going to chip in one last question. With a large proportion of office stock failing to meet the required EPC rating of B or above, what do you think will happen to this obsolete space? Who wants to take over?
We see more and more investors. Sorry.
Oh no, go Christiane, you go.
Oh yeah, just quickly. So there are more and more investors focusing on a managed to green approach. This is also something the UK government is picking up very quickly. So we're kind of developing its own SFDR, kind of rewarding this approach, and also with stranded asset in the office area. So we already see investors particularly focusing on disbursement and refurbish them and to bring them up to the ESG agenda.
Yeah, I do think there's going to be a huge amount of conversion, repositioning to alternative use, especially office to residential, which we've seen in the past with permitted development in the UK. But that also requires the public sector working with the private sector, and the planning rules around that relaxed even more. So I think, we really need to move away from it needs to be this office employment use and then you market the building for a certain period of time to demonstrate there is no office demand. I think that all needs to be relaxed a bit, because it's changing so rapidly that spaces are utilized differently today. And I think trying to convince a city official of that is a bit more difficult and challenging. So it does require a bit of more commercial thinking on the part of local councils to be able to reposition these buildings in the right way for the right use.
Yeah, absolutely. And so we're actually just on time right now, and I saw there's some more questions in there. So I think the best thing is that we'll pick them up and then we'll circulate them amongst the panelists and see if we can get some other insights and answers from you, and then share them as well afterwards with the registrants. For now, I'd love to thank you to the panelists in particular for all your insights and for taking the time to come onto the stage today. And also, of course, everyone that tuned in to be part of this afternoon session. If I just go back to the slides. So if you also would like to have more information or insights, please check our resources page on the Drooms website, where you can find latest white papers and industry blogs. And if you want to stay up to date on a more regular basis, feel free to sign up to our newsletter. We've also recorded the session, so we will be sending an on-demand version to everyone that signed up. And for now, I'll wish you all a really great afternoon, and thanks again.
Fantastic. Thanks so much. Yes, thank you.
Thanks.
Thank
Bye-bye.
you. Bye.
Bye-bye.
Take care.
Thank you. Bye-bye.